If you made a rollover contribution, is it in the right box? Right? Look at your 1099-Rs too. If you took a distribution, is it coming from the right type of account? Is it reported as a direct rollover when it should be? Things like that gives you an opportunity to audit your IRA, which you must do every year.
When I think about IRAs, individual retirement arrangements, I think it's a wonder why anyone would ever own one. You have to think about beneficiary designations. You have to think about RMDs. You have to think about various forms like 5498 or 1099-R or 1099-Q. Well, that's what we're going to talk about today with Denise Appleby. She's the CEO and founder of Appleby Retirement Consulting. Denise, welcome.
So glad to be here, and I'm so glad you're talking about this because people need to know.
They do need to know, and that's part of our goal, Denise, here is that at Decoding Retirement, we want this to be people's first and last stop in their search for not just retirement information, but also knowledge and wisdom. And you're here to help us accomplish that goal today, so thank you for being here.
Yeah, I love the name, Decoding, because as you know, IRAs are governed by the tax code. And for you and I, it's about translating that to English or decoding. I love that.
Yeah, well, it's a tall order, and you, among many, or maybe just a few, quite frankly, are the best at what you do here. So let's start here with the most recent news, which is Form 5498. To me, whenever I get this form, I have no idea what to do with it. I know that there's a place on the 1040 where I have to list something or other to having to do with 5498, but help us learn what's going on with what's new about this.
Yeah, so the challenge with Form 5498 is that, using last year as an example, it's not issued until May 31st of this year. So you have already done your tax return. You get this form and you're thinking, I'll just file it away because my accountant doesn't need it. But you need it, and maybe you should share it with your accountant. I'll give you a real-life example. The IRS just issued a private letter ruling. A private letter ruling is where, if you have a problem and your custodian tell you they can't fix it, then you go to the IRS and say, can you help me? So in this case, this person set up an account that they thought was a Roth IRA. At first, everything was fine. Then she got married, changed her name, had the custodian change the account. They still kept it as a Roth account, but they took off the Roth of the title. So every time she looked at the account, she's thinking, oh, this is a traditional IRA. And so she makes contributions to the account, thinking traditional IRA contribution. She rolls over her 401k account to that account, thinking, oh, non-taxable rollover, only to find out years later, about 2 years ago. Now, this happened in like 2012. Wow. So then she found out about 2 years ago that the account was actually a Roth. And what that meant is, let's say she rolled over $1 million from her traditional 401k, thinking that it was non-taxable. Turned out that it was taxable because she processed a conversion without knowing it. So she went back to the IRS after she got a denial from a custodian, and the IRS allowed her a late recharacterization. Remember those?
Yeah. No, they're not allowed anymore. Yeah.
After paying a professional to help her fix it and go to the IRS and paying the IRS's huge fee, the IRS says, we'll allow you to do this recharacterization. Now, the problem is, now that the recharacterization can be done, that's good. The question is, what do you do when you get your Form 5498? There's a box on the Form 5498, box 7. It's going to be checked to see if it's a regular IRA, SEP IRA, simple IRA, or Roth IRA. Had she checked that, she would have seen that it was a Roth IRA despite what the title said. So when you get your Form 5498 this year, which was just sent out in May, look at that. And that's only one of the many things that you need to look for, Bob. For instance, if you made a rollover contribution, is it in the right box? Right? Look at your 1099-Rs too. If you took a distribution, is it coming from the right type of account? Is it reported as a direct rollover when it should be? Things like that gives you an opportunity to audit your IRA, which you must do every year.
Yeah. Now, am I correct to say that the information on the 5498, which captures the gross amount in your IRAs, there's a place in the 1040 to actually list that number, is there not?
Not the gross amount, but let's say, so glad you asked that question. Let's say you took a distribution from your IRA and you rolled it over. You took it from your traditional IRA, you roll it to your traditional IRA. That's a non-taxable transaction. The distribution side is going to be reported on the 1099-R, and that's what the IRS looks at to say, oh, Bob, you took out $1 million or 100,000. You owe me income tax on 100,000, because the IRA custodian is going to report it as being taxable. But they also check a box that says taxable amount not determined, meaning as far as we know it is, but we're not swearing that it is.
Yeah.
Now, when you roll it over, it's going to be reported on your Form 5498. And that's where that taxable amount box not determined comes in, because it leaves room for your tax preparer to say, Bob, let me see the Form 5498 because I want to make sure you rolled it over, right? Or it would have been reported on your year-end statement by then. But the Form 5498 is what is sent to the IRS as proof that you rolled it over.
Right.
So your accountant used that information, and you're right. That's the information they're going to use to report on your tax return, your 1040, to say, Bob took out 100,000 and it's non-taxable. So we report it on line 4A, distribution. We exclude it from line 4B, non-taxable, and we write rollover beside it so the IRS knows what to look for when they get that Form 5498.
Yeah. So I was right to say at the beginning that it's a wonder why anyone would want to own an IRA given all the landmines that await people, whether it's Form 5498 or one of my favorites, right, is at some point in one's life, if you own a traditional IRA, you'll have to take required minimum distributions, and then you'll have to think about things like required beginning date and so forth and so on. And a lot of people miss their RMDs. How do you handle that? What are Denise's rules for handling missed RMDs?
Another minefield. But I do believe everyone should have an IRA. But you're right. You want to protect it by doing certain things, and that includes taking a required minimum distribution. Bob, I've come across cases where people didn't take required minimum distributions for 18 years, right? Especially when it comes on to inherited accounts. So you got to remember that you take required minimum distributions from your account. You have to, if you're at least age 73 this year, you have to take an RMD for this year. If this is your first RMD year, you just reach age 73, you have one due for this year, but you can take it as late as April 1 of next year. Every other RMD must be taken by December 31st of the year for which they're due. So if you wait until next year, you're going to have two to take, and that's a conversation you must have with your CPA. Should I take both of them next year or spread it out between the 2 years? Because that could affect the amount of income tax. So let's say now you hear Bob and I talking, you're like, oh my God, I didn't take my required minimum distribution. And not only that, I inherited an IRA from my uncle 5 years ago, and he was already taking his required minimum distribution, which means I have to take annual required minimum distributions. What do I do? Because when you don't take your required minimum distribution, Bob, you owe the IRS a 25% excise tax on the amount that you didn't take. It used to be 50%. As of 2023, it has been reduced to 25%. Now, people usually ask me, they would say, Denise, don't tell the IRS I asked you. But what if I just pretend I don't know and don't take it? Well,
Yeah.
Here's a reason why you should take it as soon as you find out. First of all, there's a new provision where if you miss your RMD and you take it during what is known as a correction window, the 25% excise tax is automatically reduced to 10%, right? So that's a bonus right there. The second thing is, if you miss the deadline due to reasonable error and you ask for a waiver, the IRS, I'm going to go on a limb and say will. I prefer to say will likely, but based on my experience, they've never denied a request when the reason for missing the deadline is reasonable. Let me give you a reasonable example. Someone had a 403B account. They also had a traditional IRA. they had to take required minimum distributions from both accounts. Now, the law says if you have a 403B and you have an IRA, each of those accounts must satisfy their required minimum distributions independently. Now, there's some rules that allow you to aggregate RMDs. Say you have multiple traditional SEP and simple IRAs. You can aggregate those, meaning you can combine RMDs for those accounts and take it from one if you want to. Same if you have multiple 403Bs. But what you can't do is take the RMD for the 403B from the IRA. This taxpayer didn't know, and they were actually working with a CPA who told them that they could do it. So all along, they calculated the RMD for the 403B, they calculated the RMD for the IRA, they totaled it, and they took it from the IRA. So now they have a new CPA who says, no, you can't do that. In a case like that, here's what you do. The CPA or tax preparer must file IRS Form 5329. There's a space on it where you report your required minimum distribution. In that same space, you tell the IRS how much you took, how much you didn't take, and you follow the instructions and ask for a waiver. You attach a nice letter explaining how come you missed your RMD, and you ask nicely for a waiver of the excise tax, and you put everything together and send it in. And no, don't worry if it has been multiple years. I have worked on cases where they have been multiple years, 10, 15, 18 years. And we get a letter back from the IRS saying, yeah, your request has been approved. So don't give up hope when you find out that you owe the excise tax, because there's provision under the tax code that the IRS uses to waive the excise tax if the deadline was missed due to reasonable cause.
Right. And if the IRS rejects your request, you've mentioned that it's typically because you filled out the form incorrectly. Is that fair to say?
Yes, yes, yes. I've had cases where CPAs have come to me and say, Denise, I've listened to your seminars, and based on what you tell me, the IRS wouldn't reject a request if there's reasonable cause. But here I get a rejection letter, and I say, give me that letter, let me see it. Then give me that form that you filled out. Turned out they filled out the form incorrectly, because if you follow the instructions as they're written, it can trick you, right? And so many brilliant people have been tricked by those instructions. So you got to read them carefully and make sure in the spot where it says how much do you owe, you put zero. Because if you put any other amount, the IRS is going to take that as your acknowledgement that you owe them and you're willing to pay them. So they're going to come after you for that money.
All right, Denise, we have to take a short break. And when we come back, we'll talk about maybe Form 1099-Q and RMDs again, if you don't mind. We'll be right back. Welcome back to Decoding Retirement. I'm talking to Denise Appleby. She's the CEO and founder of Appleby Retirement Consulting. Denise, when we left off, we were talking about RMDs, and I promised we were going to come back and tackle even more about RMDs. And I think one of the biggest things that people need to tackle when they think about this is, how do I actually calculate what my required minimum distribution is? It's fairly simple, but maybe not for some.
Maybe not. Maybe not. Now, when it comes to an employer plan, like a 401k, the good news is that the plan administrator will likely calculate it for you. Smaller employers sometimes farm that out to, say, an IRA custodian. But you want to know how to calculate the RMD. If you have an IRA, your IRA custodian must send you an RMD notice by January 31st. So we're in, say, 2025, you should have gotten it by December 31st, 2025. But here's why you want to know how to calculate it. If they make a mistake, you're responsible. Now, there are 3 life expectancy tables. The first thing you want to think about, the single life expectancy table, which is used for beneficiary accounts, the uniform lifetime table, which assumes that your beneficiary is 10 years younger than you are, and the joint life expectancy table. If you're married to someone much younger, more than 10 years younger, and they're your sole primary beneficiary, then you can use that table. So if you're doing your calculation for 2025, you get the fair market value for December 31st, 2024. Then you look at the life expectancy table, and based on your age, there's going to be a factor beside it. You grab that factor and you divide it into the fair market value. Voila, you have your RMD. Sounds too easy, right? Here's some things that can trip you up. Using the wrong life expectancy table. I just explained when you should use either of the three. Or if you have an outstanding transaction, Bob, say in December 2024, you took out $1 million as a distribution and you rolled it over in January. When your custodian does your calculation, they won't have that $1 million on their records. And so they'll do the RMB calculation minus the $1 million. That means your RMB is going to be short. So you got to look for things like that to make sure that your RMB is right, because it's you who's going to be responsible, not your IRA custodian.
Yeah. So in many cases, there is some uniformity between IRAs and employer plans with respect to RMDs, but that's not always the case. Is that correct?
Yeah, that's not always the case. The calculation formula is generally the same, right? And if you're still working for an employer that provides you a 401k, the terms of the plan could say, oh, you're 73, you don't need to start yet because you're still working. Wait until you retire. Don't always assume that that's an option. Check with them first to make sure. Also, if you run your own business, that option is not available to you because you're referred to as what they call a 5% owner. But one of the primary differences, Bob, is if you have a 401k account, the 401k stands on its own when it comes to RMDs.
Right.
If you have two jobs like I used to, you still cannot combine those two 401k accounts. But if you have multiple traditional SEP and Stimple IRAs, you calculate them separately. And you may say, Bob, you're my beneficiary on IRA number 1, and I like you better than the beneficiary that's on IRA number 2. So I won't take from the IRA that you're the beneficiary, but I'll take everything from the IRA where I have beneficiary number 2. So that gives you some flexibility. Do not forget your inherited accounts. When we talk about required minimum distributions, there's a tendency to think that it applies only to account owners. But for individuals who have accounts that they inherited, required minimum distributions apply to those too. In some cases, not every year. For instance, if the account owner died before they were supposed to start RMDs and the 10-year rule applies to you, then you don't have to do anything. It becomes a tax question as to whether you should during the first 9 years. You got to empty the account by the end of year 10. But if they died on or after the date they were supposed to start taking RMDs, you have to take RMDs every year. And the life expectancy factor helps to determine how much you should take.
Yeah. So we're going to send folks to your website to learn more about that and other things that we're not going to talk about today, like designated beneficiaries and non-eligible beneficiaries, et cetera. We'll send them to your website. But I do want to ask, we now live in a world where many folks are gig workers and maybe setting up solo 401ks where, in effect, they are a 5% owner. So they would be subject to the RMD rules even if they reach required beginning date. Is that correct?
Absolutely. If you run your solo 401k, you're at least age 73 this year, you have to take your RMD. Now, if you work for a huge corporation, then they could have said, wait, you don't have to. And I'm saying could, you got to check with them. But you're absolutely right. For gig workers, they're 5% owners and they don't have the option to wait past age 73.
Yeah. All right. Another form where there's been some updates is something called the IRS Form 1099-Q. And I don't know what Q stands for. Maybe we're running out of alphabets here. What do folks need to know about that?
For qualified tuition programs like 529 plans. So one of the most popular feature that came out of Secure Act 2.0 was this new provision where if you have excess amount in your 529 plan, you can move it to your Roth IRA as a regular Roth IRA contribution. You're subject to the annual IRA contribution limit each year, and you have a lifetime limit of $35,000. Now, you can do this only if you have had the 529 plan for at least 15 years. And so there were certain questions about how is this going to be reported? Because if you move $5,000 from the 529 plan to the Roth, it's going to include a prorated amount of basis and earnings. And we weren't sure how that was going to be communicated to the 529 owner. Now, the IRS have updated the form 529Q. So if you go to that form now, you'll see where there's an option for the 529 plan holder or custodian to indicate to the IRS that, yes, you have moved X amount from your 529 plan to your Roth IRA. It has been done as a direct transfer, so it meets all the requirements that it should meet.
So when someone might be moving from one employer to another, oftentimes they're told to do a 401k rollover, trustee-to-trustee transfer to their new employer if they're able, or if not, to roll it into directly to an IRA. Is there a big mistake that people need to avoid when they're doing this by chance, from your perspective?
Yes, I'm so glad you mentioned that. So you avoid a 60-day deadline by doing a direct rollover, say from a 401k to your IRA, or you use a trustee-to-trustee transfer if you're moving from IRA to IRA. Here's a number one mistake that I see happening. You set up the account, it's a Roth IRA. You tell, say, your custodian of the 401k plan, do a direct rollover to my IRA. The number is 1234567. This is a traditional IRA. The funds hit the account. It turns out that it's a Roth IRA. And so here you have an unintentional Roth conversion. So make sure it's done as a direct rollover. Verify the type of account first to make sure if you want it to go to a traditional IRA, it goes to a traditional IRA. And here's a tip, Bob. Check your 401k account statement. Do you have after-tax amounts in it? Make sure that goes to your Roth IRA. That's a tax-free conversion. Do you have employer securities? Stop and call your CPA or your financial advisor, because there's special tax benefits that could apply to those employer securities. And if you do anything, it might mess up that opportunity.
Yeah. Denise, I'm afraid we've run out of time. We never got to backdoor Roths or mega backdoor Roths, so maybe you'll come back on in a few months and we can
Yes,
talk
please.
more about that.
Yes.
In the meanwhile, though, I want to
Absolutely.
thank you for sharing your knowledge and wisdom with us and our listeners and our viewers. It's so greatly appreciated. Thank you.
Thanks for having me. And you're doing a good thing here. I appreciate that.
Thank you so much, Denise. So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you better plan for or live in retirement. And remember, you can listen to Decoding Retirement on all your favorite podcast platforms. And if you've got questions about money, about retirement, email me at yfpodcast@yahooinc.com, and we'll do our best to answer your questions in a future episode.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.